This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. For the week of February 3rd through the 7th, investors were focused on earnings reports and Trump tariff turbulence. First, last weekend's announcement of Trump tariffs roiled markets before the news of a 30-day reprieve. Manus, we do have the monthly jobs number coming out tomorrow, which investors will watch for any revisions of job growth, but there's enough policy uncertainty to keep investors' heads on a swivel.
It's certainly the case. Head on a swivel, I think, is the operative term right now. I think on the positive side, the fact that the administration stood down on these for 30 days so immediately was a good sign. The fact that they tied it to reducing the flow of fentanyl and other drugs across the border as opposed to an economic term, which I think is harder to negotiate, I think is a sign that the administration is not trying to squeeze the vice too tightly to make something break. I think that's encouraging. So we could take some solace out of that it was resolved, at least for Mexico and Canada, very quickly. Let's hope that that continues to be the case. A couple of other data points we saw this week, I think, were somewhat encouraging. Encouraging note number one is the yield on the 10-year fell about 12 basis points. Last I looked, we were at about 4.42%, down from 4.54% or so about a week ago. That's trending in the right direction. I have a theory on this, and I'm eager to hear your thoughts on it, both you, Martha, and Dianne. My thought process is here that people are starting to think that maybe, just maybe, we can reduce that $2 trillion deficit to maybe $1 trillion based on the cuts that are being made. If we make progress in that regard, if we have a $1 trillion less in U.S. Treasuries we need to sell last year, if we're not chasing that marginal buyer who's always going to require the highest yield to participate in a Treasury auction, then maybe we continue to see this downward drift on Treasury rates. Now, the bar is very high. The numbers that the Trump administration has put out as targets is $2 trillion. Even if they get half of that amount, I think that the bond markets would react very, very positively to that, and maybe we'd see a 4.0 10-year Treasury over time. That would be very, very exciting. The other piece of data that caught my attention this week was the JOLTS numbers, the job openings report, which I don't track a whole lot. I look at it here and there. It's not a big print for me. But I noticed that the job opening number is now down below 8 million jobs. At one point, I believe that was 11 or 12 million a year ago, something like that. And the fact that there are fewer and fewer job openings should be disinflationary, right? If you have fewer job openings for people to chase, the labor market is not as tight, and that should put some downward pressure on wages. Not good for the consumer, of course, but good for employers and keeping inflation under wraps. So those are my thoughts for this week. I'd love to hear your thoughts on both data points.
My reaction to the Treasury yield comment was kind of reassuring. And I think that was just on the heels of the past few weeks and listening to Trump kind of poke Powell to hurry up and lower rates. I think that kind of relationship rattled the markets a bit. And I think it's more reassuring to the market to think that the Treasury yields will be an indication of where this is headed. And certainly the market is very concerned about the federal deficit. So any efforts to bring that down, I would think, would be very positively received by the market. I will say that at the conference that I spoke at on Tuesday, which was the Environmental Bankers Association, it was the first time that anybody came up to me, and there were two separate conversations, people who were forecasting that rates would actually increase this year, that we would see at least one interest rate increase. And that was really the first time that anybody had ever said that, except in a worst case scenario. And they said it more in the tone of kind of a matter of fact. And I think that was really the reaction, I think, to the tariff news of the weekend that really scared folks that prices would go up and therefore, we would start to see some movement on interest rates. So I think what you mentioned about Treasury yields being a focus, I think is more of a comfort to the market than going back and forth about where interest rates might go.
I think there's a lot of yin and yang here, to be sure. I think that if the Trump administration pushes the envelope on tariffs, if they get more aggressive, not less aggressive going forward, if they extend the tax cuts another 5 years, if there is no progress made on the deficit, if some of those hot prints we saw in CPI and PPI in late 2024 continue into 2025, it's going to be very hard for that Treasury yield at the long end to come down. On the other hand, it is a priority for the new Treasury Secretary to get that 10-year Treasury rate down. And if we do show meaningful progress on the deficit, I do think that that will win the day. There's no assurances that they will make that progress, but if they do, I do think that the bond markets react very positively. And let's not kid ourselves that if we were to see a 10-year Treasury in the high threes, I think we would see the CRE markets just absolutely take off. You would see the velocity of transactions just really, really increase. You would see relief for borrowers that had to refinance debt. You would see workouts come more readily for distressed assets. You'd see valuations rebound. All of this would be extraordinarily positive for the market. And, I don't like to throw down the gauntlet very much, but mark my words, if we see a 390 or a 380 Treasury, I think it's going to be a great year for CRE.
Right. Well, you just rattled up a very long list of ifs, and they're all very much up in the air. So it's anybody's guess where that would head. But remember that somebody on our market advisory council actually predicted that the 10-year Treasury would fall to 3.2%, which is very hard to imagine. But I think the year's already off to a crazy start. So who knows?
I'm rooting for that 3 handle on the 10-year, I got to say. Much more than I'm rooting for either the Eagles or the Chiefs. More on that later.
Manus, you mentioned the JOLTS number, which is a report that the BLS puts out each month. It is a data point that lags their employment report by a month. The December unemployment rate ticked down to 4.1%. So it will be interesting if we see a similar pattern in the unemployment number that'll come out tomorrow.
Well, it's a very important number that we're going to see tomorrow, to be sure. Everything I'm saying right now could turn on a swivel, to use your term again, tomorrow at 8:30 Eastern time. We see a super hot jobs number. You could expect that 10-year Treasury to go shooting up again, and for people to be concerned about inflation all over. If you see a dismal number, which is possible too, I think you'll see more relief on the long end of the Treasury curve. But it's one of the downsides of cutting our podcast on Thursday afternoons, that once a month we have this notion that the jobs report is going to come out the next day and render everything we said potentially up in the air.
I have a question for you, Manus. Put on your professor hat. It occurred to me when I was listening to the news this morning, and I honestly don't know the answer. So the news headline was that 40,000 federal workers opted for the buyout, and that's 2.3 million of the federal workforce. And there's going to be downsizing of federal agencies too, so there's an impact on the labor market. What does that do to the unemployment numbers?
Well, it's hard to say. I know that they were hoping for 200,000 buyouts. The deadline is tonight, and they were up to 40,000 so far. I don't know the answer precisely either, but my guess is that since these people are going to be paid per the terms of the buyout until the end of September, that they wouldn't be eligible for unemployment until after that runs out, till sometime in the second half of the year, is my guess. So I think that the immediate impact is de minimis, but there might be somebody listening right now who has a better read on how employment law and statistics works with this particular case. But my guess is that that's how it plays out, but we'll see. It's an interesting thing, I have to say, that certainly a lot of the things that will be cut have value, that they have important factors for promoting the U.S. brand overseas and so forth. I get that, and I think that what we're doing now is a very blunt instrument. But I have to come back to the fact that the amount of spending we have in this country has really gone up almost 100% over the last, 10 or 12 years, something like that, that there has to be stuff in there that is worthy of being cut at this point. And so in that regard, I'm rooting for the new administration to find things that are duplicative, unnecessary, wasteful, not being used efficiently. I hope that they come up with something in that $500 billion to $1 trillion number without breaking something.
And so the CRE market soldiers on, which we are going to dive into the LightBox Activity Index. Dianne, where did the number end up?
So I like year-over-year comparisons more than monthlies, and January did outpace January 1 year ago, which was 76.2. And I think that's reasonable. There are a number of things in the market that are better now than they were then. Rates, of course, are ever so slightly lower. Price clarity on properties is better. Patience is waning. Investors have more opportunities. The index tracks 3 key market indicators: environmental due diligence, valuation activity by lenders, and commercial property listings. And property listings more than doubled in January over December and were 12% higher year over year. So that momentum behind the index, I think, is very reassuring to see, and we'll see how February shakes out.
I think the most encouraging thing about these upticks is that it came in a month where there was a lot of change. We moved from one administration to another, and that the breakneck pace at which things were happening, tariffs, departments being closed, layoffs being offered, every 12 hours there was another thing for investors to digest, that the fact that the market did soldier on like this last month is really, really encouraging. During periods of heightened volatility, there's normally this reaction by the markets to pull back, delay decisions. Let's hold off until things settle down. The CRE markets in particular thrive on 2 things: low interest rates and low volatility. We didn't really have either of those last month. Interest rates kind of stayed elevated in that 4.6% range. Volatility spiked on several sessions during the month, yet we saw this big spike. I happened to scratch beneath the surface on the appraisals themselves. Appraisals last month up 16% from December and 13% above where they were a year ago. That's a great sign. It just means that the wheels of CRE economic velocity of that train moving down the tracks is moving, even with a lot of noise in the market right now.
I agree with all of what you said, Manus. I will share one more observation from my conversations with folks at the Environmental Bankers Association. They definitely report to me that they're busy, so that's behind the higher appraisal numbers and higher environmental due diligence, because that was the audience. But I did really sense kind of a palpable sense of unease. So although they were very positive in terms of market sentiment, I think just the rapid pace of developments coming out of D.C. as campaign promises become real, just at such a rapid pace, I think it's starting to get people a little bit rattled and a little bit concerned. It was palpable.
I think it might even go beyond what's happening in Washington, D.C., that not only did you see that incredible pace of change, you saw 2 tragic plane accidents, and you saw the DeepSeek news, which took the wind out of sails of energy and tech providers. And you saw a couple of disappointing big tech earnings over the last couple of days. So I get it that people are a little bit anxious right now. That makes sense. There's a lot of change, and there's a lot of not quite black swan events, but unusual events taking place. And that tends to make people edgy.
Dianne, you mentioned the Environmental Bankers Association event that you keynoted at, and you had an interesting opportunity to get a pulse check of the crowd.
Yes, Martha. At EBA, we did 3 live polling questions of the audience just to take their pulse on the market forecast. So the first was, what's your view of where things are headed this year? 67% are somewhat bullish. Another 26% were somewhat bearish. So the majority, I think, huddled around the middle ground rather than any one of the 2 extremes. In terms of interest rate cuts, 58% are expecting 2 cuts this year. 23% said only 1. And I mentioned that a few people in the audience actually expect rates to go up this year. And then the last question was kind of interesting. If you could only lend on one major asset type, what would it be? 56% are on the multifamily bandwagon, and 30% said industrial. So those two are still at the top of the pile and widely perceived as low risk.
Manus, we saw more data suggesting an office rebound. A Cushman-Wakefield report said that the inventory of available sublease space, which is previously leased office space that occupiers have vacated and are putting available for sublease, has now declined by 5.6 million square feet over the past 3 quarters.
That was a promising report. We also saw some green shoots out of Manhattan as well when it was reported that office leasing in January jumped 24% over leasing in January of 2024. So there are some bright spots in the office market right now, but I would say that they're very, very limited. When I bring up some of these stats to people that I speak to in the industry, I've heard this remark more than once. The remark is, there's New York and there's everything else right now. New York is kind of coming out of the tailspin. We're seeing people take space. We'll give some examples of that momentarily. There's some long-dated leases getting done, people taking hundreds of thousands of square feet. That market is recovering, but it does seem to be a little bit of an outlier right now. Chicago, San Francisco, Los Angeles, still very much in the doldrums. So one person, in fact, said, don't be fooled by the New York activity. It's not representative yet of other markets recovering. Hopefully they will over time, but certainly in New York, there are plenty of green shoots recently.
And office resizing continues to be a news item. You saw the big one. We've talked about the GSA before a couple of weeks ago. Apparently, in the last week, an email was sent out from Washington headquarters telling regional managers to begin terminating leases on about 7,500 federal offices nationwide. And then a follow-up note said that they needed to terminate as many as 300 leases per day.
Well, it's an interesting number. The numbers are so enormous, it's hard to believe that there's that many leases that have to be terminated. It makes me wonder, what are we really talking about here? We all know that places like Treasury and the FBI and Department of Defense have huge offices in the Washington, D.C. area. How do you get to 7,500? Are these local Social Security offices that are going to be combined? I'm not sure. It's just really head-scratching to me. Do they have the right to terminate these leases? Is there a parenthetical in these leases that allows the executive to turn them off? I've never read a GSA lease. I have no idea if that's in there. And then you have the, morbidly humorous part of it, which is the same day or the same week you're telling people they have to come back 5 days a week. They may come back to only find a space available sign on their existing office. So I don't know what happens here. I do think that there's a great opportunity for the GSA to probably shed space, combine offices from various departments and so forth, cut their costs. I think that's out there. But my recollection, having looked at GSA data in the past, is a lot of these leases run 10, 20 years, things like that. It seems like to do it legally and properly, you just have to let them run off in time. I'm not sure you could actually unplug them, as is the case with the current news.
The whole issue of the DC office space is so interesting right now, and it came up in a question during the keynote at the conference this week. You have to think that office landlords are getting very nervous because vacancy rates are already high, and if these leases are terminated, that could obviously make it even worse. If they sell off office properties, that could change the dynamics a little bit too. So on those two topics, I'm really kind of interested to see how it takes shape. And for opportunistic investors, I think there could be some pretty interesting opportunities surfacing.
Yeah, I don't know how this plays out. I mean, Trump is a real estate guy. He knows the value of a lease. He knows the impact of high vacancy rates. He would really be pulling the rug out from under a lot of people by terminating leases somehow, if that's possible, that normally would have 5, 7, 10 years to run. So I wish I had more insight into this. I don't. If any of our listeners want to write in and talk about this, are leases subject to appropriations and other things? I don't really know. Is there event risk? It's something to watch, though, because the GSA is the biggest landlord in the U.S. It has the potential to really, really break something in CRE.
And another right-sizing story that was interesting, Walmart has eliminated a number of roles that's going to reshape their office footprint. Seems they're downsizing and closing some offices, the Charlotte, North Carolina office, for example, and expanding and upgrading other places like Hoboken and New York City.
Yeah, I didn't read too much into that one. I think that that's probably just healthy pruning of resources that you need. More and more places like Walmart and Macy's and others are becoming as much e-commerce operators as they are physical brick and mortar places. And for that part of it, maybe there's a bigger talent pool to draw upon in the Northeast and Hoboken and so forth. It's hard to say, but that didn't really alarm me nearly as much as the GSA story did.
I would agree. I don't think it's alarming. It was interesting because I noted that they purchased their first shopping mall in Pittsburgh.
That's an interesting one there. That's the Monroeville Mall, which is kind of from your neck of the woods. Martha, you're a longtime PA native. The Monroeville Mall, I think, sold for something like $34 million. That's down from about $215 million, if I remember correctly, 10 or 12 years ago, something like that. So about in 80%, 75% drop in value over 10 years. It seems like a smart move. It seems like Walmart has an opportunity to pick up something on the cheap, expand their footprints, not have to develop something from the ground up. It's certainly worth exploring. When you can get these malls for 80% off and you're a retailer of their size, why not give it a go?
Manus, we saw some other office news that takes us out of the New York area and into San Francisco.
Yes, we did see one big story, or a couple big stories, I guess, out in San Francisco. One was that Meta grew its footprint in the Bay Area in 2024. Why did that catch our attention? The reason is that Facebook had said in the past that it was going to look to downsize offices nationwide, and in particular in the Bay Area, yet in that San Francisco MSA, they grew their footprint last year, which is a bullish sign for the office market in that area. And it's a bullish sign for tech firms taking on more space. We've heard about this reversion. We had huge tech demand for about 10 years of office space, Seattle, San Francisco, Los Angeles, New York. Then we've seen a 2-year decline where people try to let leases expire. They gave back space. Microsoft in Seattle was a big one, Amazon in several cities, Facebook in New York. And now it seems like the tide is turning back, and some of these places are starting to pick up space like they did 5 years ago. Maybe not at the same velocity, but this is good to see. A couple of other stories we saw out of California. NVIDIA agreed to buy 4 buildings in Santa Clara from Sobrato. So that's kind of another tech story, a tech firm out there looking to pick up more space, right? NVIDIA, the darling of all darlings, if you will, in the tech space. And then lastly, also out in San Francisco, Morgan Lewis, the big national law firm, is close to inking a deal for 130,000 square feet. They will take 7 stories at 600 Montgomery, which, if I'm not mistaken, is the Transamerica Pyramid building in San Francisco. Some good highlights. Glad to report those coming out of the West Coast.
It's nice to hear some good news about office in San Francisco, too, because they've been struggling for so long. And you have to think that other companies might follow their lead. So those are both encouraging stories there, Manus.
I just want to close with a couple more notes. I did promise our listeners a couple of New York lease stories. Let me run through a few that I saw just in the last week. Visa taking 150,000 square feet on Manhattan's west side on a building that is owned by Stonepeak. Law firm Mayer Brown renewed and expanded its footprint at 1221 6th Avenue. That's part of the Rockefeller Group's portfolio. In Times Square, Knitwell, the parent company of retail brands like Chico's, Lane Bryant, Ann Taylor, The Loft, they signed a 20-year lease for almost 250,000 square feet at Boston Properties, 7 Times Square. That is a 55,000 square foot expansion. A&E, the TV operator, I don't know what their big show is. Maybe Martha or Dianne, you know what the A&E shows, or I'm sure my wife would know as well. They renewed 150,000 square feet at 227 East 45th Street, and the FDIC taking 150,000 square feet in Midtown Manhattan. So I referred to a big wave of positive news in Manhattan. That's just a taste of it.
So each year, LightBox uses its data lens to give a ranking of the Super Bowl teams. And this year, of course, it's Philly and Kansas City. So we've got some data points that stacks them up against each other. We're not going to tell you who the winner is according to our scorecard, but we will share with you some of the data points, and you'll have to look on social media and some other places for the final tally.
So yes, Martha, we're having fun with the Super Bowl picks. I went and looked up the year-on-year growth and phase one environmental site assessments for both home teams, Kansas City and the Eagles. And on that metric, Kansas City wins with 5% growth compared to Philadelphia's 1% decline in phase one's year-on-year.
So I looked at sales transactions, and what I was really looking for were transactions of size. And to Martha's point, I'm not going to tell you who the winner was, but you might say that they were separated by a field goal. The top sale in one market was a retail property that went for $175 million. The other was an apartment property that went for $172 million. So check out our social media, and we will tell you what those properties were as the top sellers for Kansas City and Philadelphia.
And a programming note, our team will be at the MBA CREF conference February 9th through the 12th. And our own Tina Litchins, who's the GM of our capital markets segment, is going to be on a panel speaking about generative AI for deal decision-making in CRE loan origination and services on Tuesday. So encourage you guys to look that up if you're going to be there. And a couple listener comments. Rich S. reached out for a copy of the CRE Expert Predictions Report. We're happy to provide that to him and anyone else who's interested. Dianne, you had another comment.
I did. I sat at lunch at the Crew Leadership Summit in Jacksonville today. Sat next to Shelly Gwen. She is with TA Realty in downtown Boston. And Shelly told me she is a loyal listener. So we appreciate you, Shelly.
So let me add a little bit to the MBA, and then I do want to hear your Super Bowl predictions before we cut out for today. But on the MBA, for those that are in the San Diego area that are going to the conference, several of us meet up for a cigar at a place called Caesars on Monday night. If you happen to be in the area and you want to meet a bunch of CRE guys and gals that just want to relax and have a cigar late in the night after all the madness ends at MBA, feel free to join us. There'll be several different firms. The velvet rope is really low there. You just have to step over it. If you can lift your feet 2 inches, you're allowed to come in. Very relaxed, very low key, and a great way to end what is usually a very busy Monday.
So I know, Manus, you're going to be headed to MBA, so you're probably going to have to watch the Super Bowl somewhere. Who's going to win, and what do you think?
They do throw a great party at MBA. It's the Sunday night. They have a great spread, terrific food. Last year, they had a former athlete there signing footballs and so forth. It's a lot of fun. But I got to say, as a Giant fan, I don't care for the Eagles. I'm a little tired of the Chiefs. They've been there an awful lot. I'm going to see if I can get them to change the channel, maybe put on that Bob Ross painting show for 3 hours rather than the game. I don't know if I'll succeed in that, but I'd rather spend 3 hours watching Bob Ross than watch these two teams, I got to say.
That's harsh, Manus. I'm not a football fan, but I'll share this. This morning on the news, Nick the Dolphin in Miami Aquarium does Super Bowl picks. So they put the logo of each team on the aquarium window and they wait for Nick to pick. And this year he picked the Eagles. So I'm going to go with the Dolphins pick and root for Philly.
I think the Chiefs are going to win, but I'm rooting for the Eagles.
I actually think the Eagles are going to win and break my heart.
All right. We'll have to see. And with that, we'll close. Thanks to our producer, Josh Bruning. Please join us each week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.